Hey everyone, in the world of global equity investing, we're all constantly on the hunt for real edge. Well, today we're going to dive deep into a powerful one that's kind of hiding in plain sight, what we call technical inefficiencies. Now, this isn't about chasing the next hot stock tip. Nope. This is about understanding those specific moments when other people in the market have to act for reasons that have absolutely nothing to do with a company's real fundamental worth.
Okay, so the entire passive investing revolution, the whole thing, is really built on this one powerful idea from Nobel laureate William Sharpe. You've probably heard it a million times. The mantra for decades has been super simple. After you factor in costs, active managers just can't beat the market. This is the bedrock, the foundation of the efficient market hypothesis. But here's the big twist. What if the very strategy that was designed to take advantage of market efficiency, indexing, is now so gigantic that it's creating its own predictable problems? We're going to explore exactly how this passive giant is actually creating a whole new, very active game. So here's our game plan. We'll start by finding the crack in the efficient market theory. Then we'll clearly define what these technical inefficiencies are and look at the huge forces behind forced trading. We'll dive into the wild cautionary tale of LTCM, and then we'll wrap it all up with an actionable playbook you can use. First up, the flaw in efficient markets. The great irony here is that the biggest trend in investing, this massive tidal wave into passive funds, might just be the single greatest gift to a certain type of active investor. See, Sharpe's brilliant analysis, for all its genius, misses a key detail of our modern market. Index funds don't care about fundamentals. They are just rule followers. They have to buy a stock when it gets added to an index, and they have to sell it when it gets deleted, no matter the price. And with trillions of dollars locked up in these passive funds, this non-fundamental trading has become a massive force, creating a much bigger, more profitable game for anyone who's willing to be on the other side of that trade. So what is it that we're actually looking for here? Let's get a really crisp, clear definition of what a technical inefficiency actually is. Here it is. A technical inefficiency happens anytime someone has to buy or sell. It's not because they had some brilliant new insight about a company's future profits. No, it's because a rule, a constraint, or some outside regulation is forcing their hand. Their goal isn't to make the most profit, it's just to stay compliant. And these opportunities, they tend to fall into three main buckets. First, you've got players who are straight up forced to sell or buy. Second, you've got the huge impact of investor fund flows sloshing around. And third, you have those rare moments when the market's traditional repairmen, the arbitrageurs, are just out of gas and can't do their jobs. Let's dig into those first two, because honestly, they are some of the most powerful and common technical forces you're ever going to see as an investor. This leverage cycle is almost like a movie plot. It's so predictable. It always starts with good vibes and easy credit, right? Borrowed money just pushes asset prices higher and higher. Then bam, some negative shock hits, volatility spikes. That triggers the dreaded margin calls, forcing all those leveraged investors to sell into a falling market. And what does that create? A fire sale. Prices get pushed way below their real value. And for a calm, well-capitalized investor, that is the moment to pounce. And hey, this isn't just a one-way street. The exact same thing can happen with forced buying. The classic example, of course, is a short squeeze. When a stock that everyone's betting against suddenly rallies, the short sellers start bleeding money. They are forced to buy back shares just to stop the pain, which only adds fuel to the fire and sends the price into the stratosphere, completely disconnected from any sort of fundamental reality. Investor fund flows, well, they create a really similar kind of pressure. We all know money chases performance, so when a fund has a great quarter, new money just floods in. What does the manager do? Well, he has to put that new cash to work, so he buys more of the very stocks that are already doing well, which just pushes their prices even higher. It's this powerful, self-reinforcing cycle, driven purely by the movement of capital. And the scale of this is, frankly, mind-boggling. One analysis actually concluded that a full 1/3 of all hedge fund alpha, their supposed secret sauce, their skill, isn't skill at all. It's just the temporary price bump they get when new money flows into their own funds. Wild, right? So what happens when all these forces collide and just spiral completely out of control? Well, for that, we have to look at one of the most famous, most spectacular blowups in financial history, the incredible cautionary tale of long-term capital management. The story is just legendary. LTCM was a literal dream team of Wall Street traders and Nobel Prize-winning economists, and they were delivering these jaw-dropping returns. But then,
in August of 1998, Russia defaulted on its debt. And within a matter of weeks, this financial juggernaut came crashing down, threatening to take the entire global financial system with it. So how on earth did it happen so fast? The answer is one word: leverage. In early 98, their asset-to-equity ratio was 27-1. Now, to put that in perspective, for every single dollar of their own capital, they were controlling $27 of assets. It was rocket fuel on the way up, but it left them with absolutely zero margin for error. Okay, so this is the real kicker. LTCM's entire strategy was built on these super complex models that showed their different trades were uncorrelated. They thought they were safe. They stress-tested their portfolio for what they thought was an improbable correlation of zero point 0.3. But when the Russian crisis hit, panic went global, and everything started moving together. The actual correlation between their positions shot up to 0.7, which basically just rendered their risk models totally and completely useless.
And you won't believe this. In a moment of just supreme irony, as the fund was literally bleeding billions of dollars, they sent a letter to their investors saying that the opportunities looked unusually attractive. You know what happened? Instead of calming people down, the letter leaked and caused mass panic among their lenders, which just accelerated the very leveraged cycle that was taking them down.
The ultimate lesson from all this is that LTCM, they were supposed to be one of the market's plumbers, right? The guys who go around fixing all the little leaks and mispricings. But when they and all the other arbitrageurs who are copying their trades all ran out of money at the exact same time, well, that's when these huge gaps between price and value can open up for the very few investors who still have cash and are ready to act. All right, so we've covered the theory, we've looked at the disaster story, so how do you actually put this stuff into practice? Let's get right to the Technical Edge playbook. Here are 4 key signals you should always be looking for. First, look for those forced sellers who are trapped unwinding a leverage cycle. Second, keep a close eye on investor fund flows, especially the huge ones going into big indexes and out of active funds. Third, hunt for those rare situations where the arbitrageurs, the market plumbers, are stretched thin or have just given up. And finally, always keep an eye on corporate spin-offs. That's when new shares are often just dumped on the market without any regard for their actual value. So this leaves us with one last kind of provocative question. As passive, rules-based investing just continues to take over the world, are these technical inefficiencies really just glitches in the system anymore? Or are they actually becoming the main feature, the primary driver of opportunity for those of us who know where to look? That is a question every single serious investor should be asking themselves. Thanks for tuning in.